Hello, once again, options traders, and happy Friday, everyone. I've got another email from one of our traders saying that he was kind of finding it very confusing about how to figure out how time and volatility are going to affect your deltas. And I've talked about this topic in a number of different ways in previous videos. This is also the Trumpification effect, but I'm going to present it in a different way to give you a really good visual so that it's very easy to figure out whether time or volatility is changing, how that's going to affect your deltas. So let's go take a look at how that's done. And as always, before we get started, please be sure to click like and subscribe. Definitely helps to promote the channel and is greatly appreciated. So time and volatility, there's really a couple of things that you want to remember about this. It'll make things a lot easier. And the first is that increasing time or increasing the volatility allows the stock's price to move more, right? A stock over 90 days has a better chance of moving to a certain level as opposed to a stock that has a week or 30 days to expiration. Same thing with volatility. We can take 30 days for a stock with low volatility versus 30 days with a stock with high volatility, and the stock under high volatility has a better chance of moving to greater levels. And yes, also to lower levels, but remember that doesn't really matter to the option because of the asymmetric payoff. So increasing time and increasing volatility are in a way two different ways of doing the same thing. They are allowing the stock price to move to higher or lower levels. And then of course the opposite is true. Decreasing time or volatility allows the stock's price to move less. And that's really what you have to understand to figure out what's going to happen to your deltas. So let's start with a simple one. Let's take a look at a long call. And this is a 100 call because we can see the bend right there at 100. We've got a flat line over here. We've got our delta 1 over on this side. So really what you want to do is to just visualize a vertical line right through your strike. And if the stock price is equal to that strike or below, you are going to have an out of the money option. If it's above 100, you have an in the money option. So now just look at what's happening to those deltas. If the option is out of the money, you're working towards this flat line. You're working towards delta 0. And if the stock is over here on this side, anywhere above the strike, in this case 100, you are working towards delta positive 1. Positive because we have upward sloping. It's like long shares of stock. So now all you have to do once you visualize this is pick a stock price. You might say, what if the stock is currently right here at 98? Well, where are your deltas heading towards? They're heading towards 0. That doesn't mean they're 0 now, but it just means that's what they will be as we get closer to expiration, that is, as time passes, or if volatility falls. That's where you're heading. What if the stock is out here maybe at 94? Well, same thing. Just imagine an arrow right there. What's it pointing to? Delta 0. That's where you're heading. That's one of the beauties of the expiration graph. It shows where everything is heading at expiration. Well, what if the stock is over here somewhere? Maybe it's at 104. Well, find 104, and we can see that if we trace a line up to it, you are heading towards delta 1. What if the stock is up here at 107? Same thing, heading up here towards delta 1. So any stock price above 100 is ultimately pushing your deltas toward delta 1. Now don't confuse that to mean that it's necessarily a profit. If the stock is down here at 101, we can see that you are heading towards delta 1, but based on the price that we've paid here of $5, we are heading into losses. It's just telling you where your deltas are heading. So that is the expiration graph. Now, of course, today's curve, the current curve, might be this in blue. So to see what's happening over time, I still have the vertical dotted line right there at 100. Now watch for starters over here just to the left. Do you see how this line is sloping up? There's some deltas there, some pretty good deltas, especially near the $100 strike. So watch what happens as we decrease time. So let's say that some time comes off the clock, a few days pass, we move from the blue to the red. We're not as steep because the red line lies below the blue. Some more time passes, we move to the green. It's not as steep. So look what's happening. These lines are starting to flatten out towards the black. See how this is starting to level off and it's starting to get very, very flat, and eventually right at expiration will be right on that black line. Okay, so let's back up and look at our current curve, but now keep your eye to the right of this dotted line. this blue line should be moving towards the black. Okay, it's fairly steep through here, but not as steep as the black. So that tells us that our deltas aren't quite 1 in this region. We're getting closer and closer to 1 as we move up this way. So watch what happens as time passes. We start knocking some time off the clock. Do you see how these lines are starting to get steeper? They're starting to lay right on top of that black line right there until we get right to expiration, in which case it lies exactly on that black line. But everything to the right of this red dashed line is moving towards delta 1. That's what the expiration graph is showing you. So that's a simple example. Let's look at maybe a vertical spread. What do you do here? Look at your strikes. There's one strike. This is the 100-105 vertical spread. We can see that because that's where the bends are in the graph. We've got another bend right there. So if the stock is somewhere to the left of this vertical line, anywhere below 100, what's that telling you? Well, you're moving towards the black. You're moving towards delta 0. What if the stock is greater than 100 or up to and including 105? As we move towards expiration, we must be moving towards delta 1, positive 1. And if the stock is at 105 or higher, what happens? Over here, we are heading towards delta 0. We're going to flatten out. So it's very easy to see. You're either delta 0 or delta 1, or in some cases delta negative 1, depending on the strategy. But once you understand that that's what the expiration graph is showing you, it's very easy to figure out where your deltas are heading. Let's try it with a butterfly spread. The expiration graph is in black. The red curve is the current curve. Now we have 1, 2, 3 bends. So this is the 95, 100, 105 butterfly. So now let's draw a vertical line through our first strike. What is this telling you? If the stock is somewhere here to the left, your deltas are moving towards 0. They're all heading towards this black line. What if the stock is somewhere between the first and second strike, somewhere in this range? Well, now we're on this positive delta right here, this upward sloping black line. So we know that all of these deltas will be heading towards delta 1, positive 1. What if the stock price is between the center strike and this right strike out here? Now we are heading towards this black line, but notice it's leaning left. Those are negative deltas. So if the stock price is in this range, your strategy is heading towards delta negative 1 as time passes. And then finally, if the stock is out here above this upper strike, you're heading towards delta 0. Once you understand the way that the deltas are moving over time, it's exactly the same thing for volatility. If you are increasing volatility, you are effectively increasing time. You're just working the process backwards. Or if you are decreasing volatility, it's the same thing as decreasing time. So for example, go back to our long call. We saw that as time passes, we move from the blue line, we're moving down this way. Well, can we reverse that? Sure. Roll the option out to a longer dated option. This might be a 30-day option. If we roll it out to a 90 or 120 days, we're doing this to our curve. We are adding time to the clock. The curve moves this way when we're subtracting time. It moves that way when we add time. Same thing with volatility. If we decrease volatility, that's the same thing as decreasing time. The curve is going to move this way. And if we increase volatility, it's going to move that way, because increasing volatility is the same thing as increasing time. Both of those cases give you more chances for the stock to make a bigger move. So it just reverses the process. So that's really a good visual way to understand what's happening with your deltas as time and volatility move. And they're critically important for options traders because you need to know how those deltas, how that sensitivity is going to be affected with probably your two biggest factors of time and volatility. And for anyone who'd like to learn more about the arts and science of options trading, please check out the Alpha Trader course, Strategy Lab, and a technical analysis course. It's all at optionsatoz.com. Also, please join us on Options A to Z's Facebook trading group, and you can find a link in the description below.